Welcome to Citi Market Watch, where we concisely unpack all you need to know on important topics. Very happy again to have joining us Audrey Cheong, Citigold Private Client Portfolio Counselor.
I'm a fixture.
These last couple of years, but especially year to date and the past couple of weeks, rank easily as the toughest and most conflicting period I have ever seen in the past 2 decades. Audrey, how are you coping?
I need to see a counselor.
Very funny. I need to see a counselor. But I agree, in fast-moving markets, especially one that has been marked by extreme moves due to the US Federal Reserve and pushed to the extremes of fat tail outcomes because of exceptional geopolitics, it is extremely important to not overreact and to talk through and understand the fundamentals and issues before making what could be rash decisions. So here's the question and thesis for today. Should we be concerned and positioning for more downside risk?
Dan, you are asking, are we headed for stagflation and or a recession? Now, well, simply put, the risks have certainly risen. For the longest time, post-2008, post the global financial crisis, buying any deep and even deeper 10 to 20% corrections has been a compelling and winning strategy. Now, only a few weeks ago, the rise in commodity prices was seen as a reflection of robust post-pandemic economic reflation, but with Fed Chair Jerome Powell testifying that inflation is a severe threat to the US economic recovery, and ECB President Madame Lagarde looking to accelerate the end of Europe's QE program, the outlook for growth slowing has risen, posing significantly more downside risks.
For more context, whilst the Russian-Ukraine war continues, we recently saw US non-farm payrolls or employment improve again, with another 687,000 new jobs created in February. This was well above the 400,000 expected. The unemployment rate is now close to historic lows of 3.8%. Manufacturing, measured by the ISM index, rose again, marking its 21st consecutive month of expansion. At the same time, after its NPC working group session, China's Premier Li Keqiang has said that China will target 5.5% GDP growth for 2022. Audrey, at this point in time, what else can we note to have an objective view?
Well, we have to remember where we have come from. In June of last year, the S&P was at 4,200, and with energy hitting $130 per barrel, Russia invading Ukraine, we are now with a drawdown to date still around 4,200. But we do note that global financial conditions are tightening, though still around 10-year averages, whilst US financial conditions remain very loose compared to its 10-year history.
Thank you, Audrey. We also talked about and highlighted Citi's bear market checklist 2 episodes ago. With the recent volatility and drawdowns, we currently see 35% of the 18 factors as cautionary red flags. So we are still far from the 50% that really triggers alarm bells of an imminent bear market. We are living in very, very fluid times. In many ways, we are transitioning into a new paradigm, one of relatively higher inflation. Hence, the need for more thoughtful and considered money management is acute. Please do listen to our podcast, where we will dive deeper into these developments. And do speak to your Citigold or Citigold Private Client relationship manager for more context for your portfolio and opportunities.